Good morning, everyone, and welcome to our Long-Term Perspectives webinar. My name is Khonsi Tsatsi, Head of Retail Clients at Old Mutual Investment Group. Long-Term Perspectives is a publication that we publish annually, and it looks at over 90 years worth of data around asset class returns. And from doing this for a very long time, we've been able to distill some of the lessons that this data shows us and come up with 8 principles of long-term investing, which we're going to share with you in a bit more detail today. Why is long-term perspective significant right now? We've got highly volatile markets. We've had low returns from your traditional asset classes that are supposed to drive growth. We're marred with high inflation and low economic growth in South Africa. All of these conditions are really difficult for clients, and they can lead to clients making investment decisions that could harm them in the long term, hence the importance of a publication like this. Please also note that this webinar will qualify for CPD points, and towards the end of the webinar, we will publish a link that you can click onto. It's got a questionnaire there. You fill the questionnaire in and then click send, and then we'll be able to capture all of your details and ensure that you get your CPD points. I'm now going to hand over to Graham Tucker, who's Portfolio Manager for the Balance Fund. Graham also heads up our multi-asset solutions business, and he's going to share with us a couple of slides. In terms of what we'll be covering today, we're going to be focusing on 4 of the 8 lessons in long-term perspectives. Graham, over to you.
Great, thanks, Khonsi. And welcome everybody. Thanks for dialing in. As Khonsi mentioned, we've been doing this for a while now. This is actually our 10th edition of Long-Term Perspectives. And part of the reason we do this is because we believe it adds value in the investment sphere. We are, when we're going out on the road and we're talking to advisors and we're talking to clients, we get very similar questions that come up time and time again. And some of those questions we feel, it's just a matter of not having the information at your disposal. And so that's what we're trying to do with long-term perspectives, is to arm people with the information so that they can make the right investment decisions for their future in the long term. So, as Khonsi said, we're going to touch on a few of the lessons today. So let's kick off with that. And the one I wanted to start with is lesson number 1. It's the most important lesson as far as I'm concerned, and that's understanding that your enemy is inflation. It's not volatility in markets. It's about inflation, and we'll go into that in more detail. In order to combat that enemy, in order to fight them off effectively, you do require equities. And this can often be quite scary for investors. But what evidence shows us, what history tells us time and again, is that equities give us those long-term real returns that we need. However, you don't have to rely on equities alone. There is value in diversification. So that's the third topic we're going to be covering. So you don't have to hold just equities. You can diversify into property or into bonds, wherever it may be, because at times those other asset classes do give you more attractive returns. And in fact, when we look forward over the next 5 years, South African bonds does look very attractive to us. And then the fourth lesson is really around how is tackling investor behavior. And so I'll talk you through some examples that we've encountered in the last 10, 15 years around investor behavior, and how at times that has actually done quite a lot of harm to investors' ability to grow their long-term wealth. So let's kick off with the first one, which is around inflation. And we always have this quote from Ronald Reagan in Long-Term Perspectives that inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. And in this chart, what we're showing is what does inflation actually do to your real spending power? So if you start off with 10,000 Rand as an example, and you assume various levels of inflation, 3, 6, and 9%, what you see over time is that they detract from your real wealth. They erode your spending power. Those inflation scenarios. To the point where if you've got a mild 3% inflation scenario over 30 years, that takes away almost 60% of your spending power. So your 10,000 Rand becomes worth just over 4,000 Rand over 30 years. But if you actually are operating at a 6% inflation level at the upper end of the band that the South African Reserve Bank is trying to achieve, if your 10,000 Rand drops by more than 80% in terms of real spending power. It drops to below 2,000. And then obviously 9% inflation has an even more detrimental effect to your spending power. So that band 3 to 6%, if you're not saving, if your clients aren't saving appropriately, then they will see the value of that 10,000 Rand decrease over time. It might stay the same or even go up slightly in nominal terms, but the real value of it drops. And so that's what we're concerned with. And that's why we primarily look at the ability of asset classes to deliver returns. We look at that in real terms, so taking out the effects of inflation. If we look at what's happened in South Africa, South Africa's inflation rate over the last 90 or actually 100 years in this instance, we can see that our inflation rate has bounced around a bit. And we had, there's obviously a lot of uncertainty in the early 1900s. We then see some stability into 1970. And then as you had gold prices de-anchoring and you had oil prices moving higher, you saw South Africa's inflation rate move up into double-digit territory. This wasn't an unusual reaction. We saw it with global, and we'll see that in the next slide as well. But there was a concerted effort to then try and tackle inflation. And we saw that with the inflation targeting approach followed by the SARB coming in during the late 1990s. And as a result of that, inflation in South Africa has moved to more appropriate levels. So the band that we're now targeting is 3 to 6%. And by and large, the Reserve Bank has done a fairly good job in terms of remaining within that target. Yes, we have seen some blowout in the short term, as we've seen recently coming out of the COVID period, but by and large, it's been fairly well behaved in terms of that being within that 3 to 6% inflation band. If we now turn to global inflation, so as I mentioned, we saw a similar spike in global inflation in the late 70s and early 80s. You then had Paul Volcker coming in and deciding that the US had to tackle this inflation issue, and they increased rates significantly off the back of that. Since then, you've been in this disinflationary period globally. So as represented by this G7 inflation index that we're showing here. And that disinflationary period is evidenced by those decade-long averages in the maroon lines. So from the 70s to the 80s, reaching that high point, and then decade after that, moving steadily lower. Now, what we've seen post-COVID is obviously inflation spiking up due to logistical issues, due to activity returning to the market and demand outstripping supply, etc. That's going to come back. That's a short-term spike that is already starting to unwind. But so we're not as concerned about that short-term story. We're more concerned about the longer-term issue around inflation. And in our view, we believe that this disinflationary phase that we've gone through for the last 40, 50 years is now going to change. We're seeing a regime change in inflation, and actually inflation is now going to start picking up again. So in our view, the next 10 years, we're probably going to see inflation closer to what we saw during the 1990s, so kicking up roughly to the 2.5% level. And then there's potential that it might even move a little bit higher from there, but we'll assess that as we move through this decade. What's driving that higher inflation is really three key factors. One is around demographics and the idea of aging populations and higher dependency ratios. That typically drives up inflation over the long term. What we also saw over the last 40 odd years is this move around globalization. And that, if you think about companies moving their manufacturing businesses over to China because it's cheaper labor and so on, and it's just becoming a more connected world in terms of how businesses operated, that helped to drive costs down, so that helped keep inflation lower. That, in our view, is starting to change. So we believe that the world has reached the period of peak globalization, and actually we're going to start to see some deglobalization. We're going to see some of those benefits unwinding. And you're already seeing some of that take place with investment in the US in terms of their manufacturing processes, some processes moving back to the likes of Mexico. So this whole idea of reshoring or onshoring or friendshoring, all starting to take place, and that, in our view, is going to gather more and more steam as we move through this decade and into the next. And then the third key driver is around decarbonization. So the need to tackle the climate change and so on. It's going to drive up the cost of commodities, because many commodities are very important in terms of how we tackle climate change. But then that's going to drive up those prices, and that's going to drive up inflation off the back of that. Now, importantly, all three of these factors are structural in nature. So while coming out of the COVID period, and the supply chains was a cyclical story, demographics, deglobalization, and decarbonization are more structural in nature. So this gives us confidence that as these three forces play out, they're going to keep inflation elevated, and more so than what we've seen in the last 30, 40 years. So that's the story around inflation. How do we tackle inflation? And that really talks to the next section, which is the need for equities. So what we talk about in long-term perspectives is how asset classes have delivered over the last 90 odd years. And here we're just showing you the South African asset classes being cash, bonds, and equity, and how those compare to inflation. So inflation over this period has averaged about 6%. Cash has given you 6.9 over that period, annualized. Bonds 7.9 and 13.7. So equity clearly giving you superior returns over this period, and giving you superior real returns. If we just quickly decompose those returns and just try and understand what's driving those different returns that we're getting, well, quite simply, with SA cash, you're taking on minimal risk, so you get minimal reward. So you get slightly above inflation for that. But if you're prepared to lend money out for longer time periods in the likes of South African bonds, so if you're prepared to lend money out for 5 years, 10 years, or 20 years, you've achieved a slightly higher return off the back of that. So you've been compensated for taking on that additional, what we would refer to as term risk. So that equates to roughly 1% on top of what you've seen on cash. But actually, if you're prepared to take on equity risk, that's where you've really seen the enhancement in your return coming through. So by moving from bonds into equity, so you're moving from debt into stocks, and you're increasing your risk profile around that, you've actually, over the last 90 odd years, you've been rewarded with an extra 6% return almost on top of bonds. Now, what does this all mean in terms of trying to generate your wealth? Well, this is what, for those of you that have attended Investment Insights, this is something that we've been talking to. And it's really saying what we need to do as investors is generate real wealth. So how long does it actually take you to double your real wealth if you were invested in equities versus bonds versus cash? And if we assume those returns that we saw on the previous slide, those long-term returns, we assume that those play out, then it would take you roughly 10 years to double your real wealth in SA equity, nearly 40 years in SA bonds, and you're looking at the 22nd century to double your wealth in real cash, to double your real wealth if you invested in South African cash. So that for us is a very compelling story around why cash is actually a long-term loser when it comes to generating real wealth for investors. Another way of showing this is if we look at what we refer to as our Smarty box, and what this is really showing is the performance of each asset class over longer time periods. So we go out from 5 years on the right-hand side of the chart, all the way out to 50 years on the left-hand side, and then we're just showing with those bubbles, with those Smarties, where each asset class has ranked at the end of the day. And then just a couple of points that I want to illustrate with this chart. So we're going to remove some of the busyness in here, and let's just focus on equities and inflation. And what you see here is that even though equities might be volatile in the short term, if you extend your holding period to 5 years out, but even longer than that, you typically get better returns out of equities versus many of the other asset classes. Now, yes, over the last 5 years, we know that SA equities haven't given us the real returns that we require. There is a very good reason for that we all know, and that is South Africa hasn't delivered the economic growth that it needs. So we've had a lost decade. But putting that aside, if you look at the 10-year period out to the 50-year period, equities typically rise to the top and deliver very good returns against inflation, which is sitting near the bottom of that table. Now, let's focus our attention on South African cash. So what has cash delivered over these holding periods? And while cash in the short term might give us safety, might make us feel comfortable that we're not going to lose money, what we see is that if you hold cash for too long, you miss out on returns that are being offered either by property or by equities or even bonds in some cases. Cash typically sinks to the bottom of this ranking table as you expand your holding period. So that's the story around the need for equity. However, there is an important part in building a portfolio, and that's around diversification. Many investors can't tolerate the idea of being invested too heavily in equities because of some short-term volatility. So this is where diversification plays a critical role. So what we're doing here is taking the Smarty box that we show in long-term perspectives for annual returns, but we've changed the way we're reflecting this, just the way we're showing this information. And what we're showing here is the gray bar is the range of returns, so it's the minimum return versus the maximum return. And then we're showing you which asset class was top and which was bottom, and then also showing you how the balanced index performed. And the balanced index is simply a combination of these various asset classes in a way that you would see in a typical balanced fund. So as an example, the balanced index has 65% exposure to equities split between local equities and global equities. But then it will also hold South African bonds, will hold global bonds, etc., etc. Now, what we see if we look at this on a year-by-year basis is what I find quite interesting is that you don't find the same asset classes outperforming every single year. Sometimes it's global equity, sometimes it's gold, sometimes it's property. That leadership changes year by year. On the other side, if you look at the minimum return, you see something similar playing out. So different asset classes are underperforming in different years. And the fact that this is changing the way it is over time from year to year, I think can create a lot of uncertainty for investors. But if you look at the balanced index, what you see is more often than not that balanced index gives you a fairly good return each year. Obviously, it's dependent upon the returns that are available and that you can achieve in the underlying asset classes. But it's smoothing out a lot of that volatility that you see and giving you a fairly stable return profile year by year. So this for us is a very attractive story around diversification. And if I just look forward if we just look at how that plays out in the balanced fund on a longer term basis, so again, going to this longer term view of the Smarty box, you see that the balance index actually gives you very good returns over time. So you're not sacrificing that much in return, but what you are gaining is actually a sense of comfort that you've got a multi-asset class fund that can deliver with relative stability. If we look forward to the next 5 years, I think this is where the diversification story becomes quite important as well. So for those of you that have attended Investment Insights, you'll know that our view at the moment is forcing us to hunt for opportunities outside of equities. So we're looking at global bonds as an example. South African bonds are offering some really good value. So we're not necessarily hunting in the equity space or finding as many opportunities in the equity space. So this whole idea of diversification plays out there very nicely. But also, if you just think forward 5 years, there are some of those asset classes are providing much better returns than what we would expect to see or what we have seen historically. So South African bonds, they're offering a lot of value. So we think that they can deliver a real yield of 6.5% over the next 5 years. And if you turn your attention to the global side, yes, global equities are expected to deliver better returns than global bonds and global cash, but that gap is a lot smaller than what you would expect to see. So in terms of that equity risk premium, you're not getting rewarded for equities as much as you would typically expect going forward, in our view. The fourth topic I wanted to cover was around investor behavior, and the two main drivers that I see impacting the returns that clients achieve at the end of the day. The one is equities, and the second is the currency. And typically, when we're out and talking to you, these are those questions that come up. So I just wanted to talk through a couple of examples, and how actually sometimes when investors panic, it becomes a very costly decision at the end of the day. So I've chosen two examples of the rand moving sharply weaker here. There are many examples. I've just selected these two for to illustrate a global event and a local event. So the global financial crisis back in 2008, 2009, you saw the rand weaken quite sharply into the back half of 2008. And so I've indexed everything to 100 here. So what this basically means is that from the middle of the year to the weakest point of the rand had weakened 40% against the dollar. Now, typically, when that happens, people become quite nervous, they become quite panicky, and the reaction is to, well, now I have to take money offshore. And you saw something similar with Nenegate. The currency weakened by almost 25% in the period leading into Nenegate and just after that. But now, if you take your money offshore at that point in time, how has that actually played out for you? Well, the maroon line is showing you how the currency reacted after that. And you saw in both these cases, the currency giving back all of those losses. So as a client, as an investor, if you've taken money out anywhere in those spikes, you've lost a significant amount of money on the currency coming back over the next 6 to 12 months. So again, taking money out or offshore in these times of panic has actually cost you and cost the investors at the end of the day. If we turn our attention to equity, we see a similar pattern developing here. Again, I'm looking at the global financial crisis, but then I'm contrasting this against the COVID correction that we saw in 2020. So in both instances, the South African equity market had fallen by nearly 35%, so gone from 100 down to 65. How has it behaved after that? Well, the markets bounced back sharply and actually made new highs in many instances. So again, if you've sold equities anywhere near that bottom because you're worried about markets and you're worried about all the bad news that's out there, the market already knows that. The market has already priced that in. And actually, it's looking forward and saying, how do we recover from this? And so yes, if you've sold anywhere near the bottom, you've locked in that loss, but also you've stopped yourself from getting the gain on the other side of the story. So again, investor behavior is incredibly important in terms of growing your real wealth. And just another way of, that's maybe a shorter term story. A longer term story is actually around crises. And I'm just going to contrast, I'm just going to have a look at Eskom as an example, so taking a bit of a detour here. But if you think about Eskom is able to generate a certain amount of electricity every single day. And then there is demand for that electricity by South African businesses, South African consumers. Now, ideally, you want to be in a situation where your supply exceeds your demand. But as we well know, we're not in that world at the moment. And so we have a situation where either supply needs to be increased, or we need to go through load shedding, or we just say, we're just going to draw as much as we need, and we're going to experience a grid failure and a blackout. So none of these are actually very palatable options, and none of them are short-term solutions or even long-term solutions, to be honest. So increasing supply is not something that can be done easily and quickly. That takes a lot of time to build. Implementing load shedding, we've been living with that for the better part of a year now, and actually in terms of the worst parts of load shedding, but actually we've been living with this for more than a decade. And obviously experiencing a blackout is, nobody wants to go through that. That would have probably the biggest impact on South Africa and South Africa's future. So therefore, what's happening is we're going with load shedding on so rotational energy reduction schedules. If we now look at that and contrast it to investors, so investors save and grow those savings for an event, typically their retirement. Once they retire, they then draw down on those investments. So you have the supply side being the savings, and you have the demand side being the drawdown. However, and this is one of the stories that we get time and time again when we're out traveling, is that clients are often drawing too much given their level of savings. So what do you do? And well, again, I think there are three options. Number one is you increase your savings or increase your supply. Number two is you have to reduce the size of the drawdown. So you have to implement some sort of load shedding. Or number three is the clients just continue to draw down at those rates, at which point they deplete their savings far too early, and that has a material impact on their later years in life. Why I'm putting these forward is because at the root of both these crises, and you can extend this to other crises, but at the root of these crises is the action or lack thereof that taken many years before that. So in this instance, both these problems can't be solved today. It's about how this started years and decades ago, because investors didn't save enough, or they didn't invest in the right vehicles. They were too hesitant, keeping money in cash for too long and not investing in equity markets. But actually trying to deal with this now is the horse is largely bolted. It's an incredibly difficult, if not impossible, problem to deal with. There has to be pain felt somewhere. But actually, if we can address investor behavior much earlier in an investor's life, we have the ability to reduce the size of these issues going forward. Benjamin Franklin and Winston Churchill both said something along these lines, and it's, if you fail to plan, you plan to fail. And I think this is exactly what we've seen in the case of energy and Eskom, but also what we're seeing with many investors and how they think about saving for their future. So what do we do in terms of our funds? So this is the range of multi-asset class solutions that we offer within Old Mutual Investment Group. It spans from real income all the way to maximum return. And there are three things I want to point out here. So one, all of them include a certain amount of equity. in order to deliver 2, the specific return that they're targeting, and 3, within a suitable investment time horizon. Now, all 3 of those things, the amount of equity, the return, and the time horizon, are all linked. You're not going to get those great returns from equities in the short term. So you have to allow time to work its magic, and those equity risk premiums to play out in order to deliver those returns. So you have to link time with return with level of equity when thinking about a longer term solution. So just to bring it all together, so what we've spoken about here and what we talk about in long-term perspectives is understanding the importance of inflation as being the main enemy that clients face. And the thing about inflation is it eats away at you year by year, and without you necessarily recognizing it. So it's important to understand that is your true enemy, and tackle it as soon as possible. In order to tackle it, you have to have the appropriate level of equities. Equities have shown that to deliver the real returns that people require. However, you also can't just hold equities. It pays to hold a diversified portfolio, because different assets outperform at different points in time. And as we've seen in the last 5 years, South African equities haven't actually given you great returns. You wanted to hunt elsewhere. And then the fourth point is really around investor behavior, and just reiterating how key it is that investors, often the way they behave has such a detrimental effect on their real wealth at the end of the day. Actually trying to address some of those behavioral characteristics is incredibly important, and one of the key reasons why we put this publication together. And I'm going to end there. Fonzie, back to you.
Thanks, Graham. I'm going to encourage those of you that are online to take the opportunity to ask Graham any questions that you might have. So if you do have any questions, please pop those over into the chat. In the meantime, though, I just want to remind you that we've got a number of resources that you can use with long-term perspectives. A lot of the feedback that we've gotten from planners is that the resource or the publication is mostly useful in its physical form, not really very ESG friendly, but anyway, that's what we've heard. And typically a planner will sit with it in their practice, and as they have conversations with clients in any one of these challenges which long-term perspectives deals with comes up, then the planner would pull out the publication and actually use it in a conversation. You will see in the chat that Donnie Bruce, one of our moderators, has posted a link there. That link will take you to our website. On the website, there's a page that's dedicated to long-term perspectives. On there, you'll be able to find the publication itself in PDF format. You'll also be able to find a couple of videos that we shot that speak to each of these principles of long-term investing. And it's around the same sort of 4 that Graham covered today. You'll also find a sales guide there, or a summary guide that you can use. And then also in the chat, you will find a link to the questionnaire that was also posted there by Donnie. That's the questionnaire that you've got to fill out and then click send at the end in order to get your CPD points. And I do see that we've got a couple of questions here. It says here that, Graham, a retiree cannot afford a decade of underperforming CPI. How must retirees then manage their asset allocation and drawdowns to ensure that this does not happen if an asset manager you battle to deliver exceptional returns after costs and fees? Graham, over to you.
Yeah, so it is a challenging one, and It's why I was trying to talk about the where we are now if you compare the Eskom and investor situation. But I think markets haven't necessarily given great returns over the last decade or so. A big part of that for a multi-asset class fund is going to be the performance of SA equity, and that is because SA equity hasn't delivered, or the South African economy has delivered subpar growth. I think one of the things that we do see is that there is quite a lot of value stored or locked up in many SA equity counters that should be relatively easy to unlock. I think part of that has been driven by the last year or so of Eskom and our energy woes. So if I look at clothing retailers, we can buy them at 50% of their book value that we've seen over the last 20 years. If we can just grow at 2%, that should be enough to unlock a fair amount of that value. And you're seeing a similar thing with South African bonds and so on. So there is value out there, and we are seeing returns improving on a 5-year basis on the local asset side, especially. But I think one of the other things is the relaxation of the global limit from 30 plus 10 for Africa to 45% single limits that we saw last year does open up the ability to hunt in the global universe a lot more. And while we're not expecting fantastic returns from global equities over the next 5 years, a lot of that is driven by US equities. So we actually do see opportunities elsewhere. There are a lot of emerging markets that look attractive. Even if you think about the higher inflation story and what that means, the takeout from that from an investment perspective is it should benefit the value style over the growth style. So there are opportunities globally, and relaxing that limit does allow us as investment managers to find more of those opportunities rather than being forced to hunt solely in the SA equity space.
Thanks for that, Graham. The next question asks, what is OMIG's views of the property market or the property sector?
So again, South African property, I didn't point it out in that annual slide, but you can see it in the publication. South African property has been one of the worst performing asset classes each year for, I think it's 3 of the last 5 years. And then we had a delivered very well in 2021, if I remember correctly. So property did very well in the early 2000s because of a supply-demand imbalance. So there was a lot of demand for the level of supply. And we were also in a disinflationary environment, which meant that should benefit bond yields and hence the property sector. We then started to see the supply story change and a lot more supply coming online, but then demand tapering off because of South Africa's lost decade of growth. So that created a very poor environment for the South African property sector. Where it stands today is we think that a fair degree of that supply-demand balance has unwound. There's obviously a lot of bad news in our built into our bond yields at the moment. So bond yields look very attractive. That should be supportive of the property market. So we're seeing a lot of value there and ways that value can unlock. But in terms of the way we've structured the portfolios at the moment, we haven't gone into South African property in a big way. So you could define our position as neutral, SA property. So there's value there. It can be unlocked. We just want to see a bit more evidence of things coming through. And in terms of exposing clients to South African risk, we're preferring to do that at the moment through bonds and through the likes of your banks and your clothing retailers. But property, the outlook for property is starting to improve on the margin.
Thank you very much, Graham. I see that there's a comment around the link. The link is there for the CPD points if you just look into the chat function. But if you don't see it, you can also reach out to your relationship manager and they'll facilitate getting the link through to you so that you can get your CPD points. I want to thank everyone for dialing in today and encourage you to follow those different links that we've shared so that you can get more resources on long-term perspectives. We will also have a recording of this video available. Should you need to recap or have a look at things again, you'll be able to do so, and you can source that from your relationship manager. Big thank you to Graham for sharing his insights, and thank you for joining us, and have a great day further. Goodbye.